Most traders believe their biggest results will come from a big discovery, a secret indicator, a perfect setup, a dramatic change in strategy. That belief costs them years, because in trading, the largest improvement often comes from the smallest correction. Not a revolution, a tiny fix, one adjustment in behavior, one better habit, one repeated mistake removed. And over time, that small shift changes everything. Have you ever looked back at a losing week and realized it wasn't market conditions that hurt you? It was one decision you kept repeating, not 10 mistakes. Maybe entering too early, maybe moving a stop, maybe forcing a trade because silence felt uncomfortable. It seems small in the moment, almost harmless. But markets are built on repetition, and repetition magnifies everything, good or bad. That is where huge results begin. Not in brilliance, in correction. Watch traders closely, and you'll notice something strange. Two traders can study the same chart, use similar setups, even understand the same principles, and still produce completely different outcomes. Why? It's rarely knowledge, it's behavior under pressure. One waits 5 extra minutes for confirmation. The other jumps because he fears missing the move. One accepts a stop, loss as business expense. The other turns a controlled loss into a dangerous position because he knows price will come back. One trader protects mental capital. The other spends it carelessly. Tiny fix, huge result. And here is what makes it difficult. The small mistake often feels reasonable. That's why it survives. Have you noticed how bad habits in trading usually disguise themselves as logic? I'm just giving it room. I'm just scaling in. I'm just being aggressive while volatility is high. No. Often, you're feeding impatience, fear, or ego, and calling it strategy. The market has a way of exposing that. Not immediately. That's what makes it dangerous. If every bad habit caused instant pain, traders would correct quickly. But markets sometimes reward poor behavior in the short term. A reckless trade wins. A moved stop recovers. An emotional entry runs straight to target. And what happens? The bad habit gets reinforced, because creates effect, effect creates belief, belief creates repetition, repetition builds identity. Now you don't just make impulsive decisions, you become an impulsive trader. Do you see how something tiny becomes structural? That's the hidden architecture of performance. The opposite is also true. A small discipline repeated becomes edge. A trader decides, I will only trade clear structure. That sounds simple, almost too simple. But now fewer forced entries happen. Because fewer forced entries happen, emotional swings reduce. Because emotional swings reduce, decision quality improves. Because decision quality improves, confidence becomes grounded, not emotional, but earned. Because confidence improves, patience becomes easier. One fix creates a chain reaction. That is trading. A chain reaction business. So what should you actually look for? Look for friction. Where does trading feel heavier than it should? Where do you repeatedly experience regret? After which decisions do you say, I knew better? That sentence is gold. I knew better. Inside that sentence is your next breakthrough, because it means the problem is not knowledge, it is execution. And execution problems are usually precise, specific, correctable. Maybe your fix is position size. Most traders trade too large for their psychology. Not too large for their account, for their mind. Big difference. The size may look mathematically fine, but mentally it creates noise. You stare at every tick, you become reactive. You exit winners early and hold losers emotionally. Reduce size slightly. Just slightly. Suddenly you think clearly. You hold structure longer. You stop interpreting every candle as danger. Better thinking produces better action. Tiny fix. Huge result. Or maybe your fix is timing. How many bad trades come from needing action now? Ask yourself honestly. Do you trade setups or do you trade boredom? That question cuts deep because many traders are not fighting markets. They are fighting stillness. Waiting feels unproductive, so they manufacture opportunity. But money often comes from inactivity, not activity. From waiting, not chasing. From preserving ammunition until probability tilts clearly in your favor. One extra layer of patience changes your entire equity curve. Another tiny fix, huge result. Maybe your problem is interpretation. You see a loss as failure. That creates hesitation. Hesitation creates missed opportunity. Missed opportunity creates frustration. Frustration creates revenge trading, and revenge trading creates deeper loss. But what if one mental shift happened? What if a loss became neutral information? Nothing personal, just feedback. Then emotion reduces. Clarity improves. Process becomes stronger. Recovery becomes faster again. Tiny fix, huge result. Notice the pattern. Trading outcomes are often downstream from invisible habits. The chart is visible. Your pattern of thought is not. That is where serious traders work. Quietly, honestly, without ego. You don't ask, how do I make more? You ask, what small leak keeps draining me? That question changes everything. And when you find it, don't attack 10 things at once. That is another mistake. Too much correction too quickly. Human behavior doesn't change under overload. It changes through focused repetition. Choose one fix, one. Work on it until it becomes automatic. Maybe it's respecting stops. Maybe it's waiting for close confirmation. Maybe it's trading half size. Maybe it's ending the day after 2 losses. Simple things, powerful things. The market does not reward complexity nearly as much as it rewards consistency. And consistency is built from refined behavior, not dramatic insight. So next time you review your trades, don't search for genius. Search for the small hinge that swings the large door. Ask yourself what one adjustment, if repeated daily, would quietly change everything. Sit with that, because somewhere in your routine, hidden in plain sight, is a tiny fix carrying enormous weight. Most traders do not lose because of one catastrophic mistake. They lose because of small leaks they refuse to notice. A little impatience here, a slightly oversized position there, one stop moved wider, just this once, one revenge trade after frustration, one entry taken from boredom instead of conviction. Each act feels minor, each decision seems forgivable, but markets have a brutal habit. They collect every small weakness and compound it. That is how strong accounts quietly weaken. Have you ever wondered why your good trades sometimes fail to translate into real account growth? You can read price well. You can spot opportunity. You can even be right often enough. Yet the account feels heavy, slow, stuck. Why? Because profit is not only built by what you make, it is shaped by what quietly drains you. Small leaks, invisible costs, repeated damage. A trader may spend weeks developing patience only to break discipline in one emotional afternoon. Not because he lacks skill, but because his habits have cracks. And cracks under pressure always widen. The dangerous part is this: small leaks rarely create immediate alarm. That's why traders ignore them. Overtrading does not feel destructive on one day. Entering slightly early doesn't seem serious once. Taking profit too fast appears harmless in a single trade. But repeat that behavior 50 times, 100 times, 200 times, and now the account reflects a pattern, not an isolated mistake. Because becomes habit. Habit becomes outcome. Outcome becomes identity. Then the trader says, maybe my strategy doesn't work, when in truth the strategy was never the leak. Behavior was. Look closely at where your account bleeds. Do you trade when conditions are unclear because sitting still feels uncomfortable? Do you increase size after a win because confidence quietly becomes greed? Do you hesitate on valid setups because one recent loss still lives in your mind? These are leaks. Not dramatic enough to shock you, consistent enough to weaken you. And what makes trading difficult is that leaks often wear smart disguises. Fear calls itself caution. Greed calls itself confidence. Impatience calls itself aggression. Ego calls itself conviction. You think you're making strategic choices, while emotion quietly steers the wheel. The sharp trader learns to inspect the hidden places. He asks hard questions. Why did I really enter there? Why did I ignore my plan? Why did I size the trade differently? Why did I need action at that moment? Honest answers expose leaks, and once exposed, small leaks become fixable. Sometimes the answer is as simple as reducing frequency. Fewer trades, but better decisions. Sometimes it is smaller size, so your thinking stays clear. Sometimes it is stepping away after a loss, refusing emotional momentum. Sometimes it is waiting for confirmation instead of predicting movement. Tiny correction, massive effect. Because when leaks stop, something powerful happens. Your good habits finally have room to work. Your edge begins to show. Patience starts paying. Discipline creates consistency. Confidence becomes stable because it is built on repeated right action, not lucky outcomes. Do you see the shift? You stop focusing only on making money. You start focusing on stopping unnecessary loss. That changes how you think. A wise trader protects capital the way a ship captain protects the hull. Not because storms are avoidable, but because even small openings invite water in. And water does not need drama to sink a vessel. A slow, unnoticed leak is enough. The market rewards those who respect small things, small discipline, small restraint, small honesty, small correction. Most traders chase profit before they build precision. That is why so many remain stuck. They think trading is about finding bigger moves, taking larger positions, or discovering some hidden advantage others have missed. But markets rarely reward urgency. They reward accuracy. They reward discipline. They reward the trader who learns to act with clarity instead of impulse. Profit is not built first. Precision is. Have you ever noticed how careless decisions rarely look careless in the moment? An early entry feels like confidence. A rushed trade feels like decisiveness. Ignoring confirmation feels bold. Breaking a rule feels justified because this setup looks different. But beneath every sloppy action is one quiet truth. You acted before your process was clear, and unclear action carries hidden cost. Not just money, mental damage. One impulsive trade creates frustration. Frustration clouds judgment. Clouded judgment creates another weak decision. Weak decisions build emotional pressure. Soon, you are no longer trading the market. You are reacting to your own mistakes. That is what lack of precision does. It creates noise where there should be order. The sharp trader understands something most never fully accept: being approximately right is not enough if your execution is consistently loose. Good analysis can still produce poor results when timing is rushed, entries are random, stops are emotional, and exits are guided by fear or greed. Skill without precision leaks value. Edge without precision gets buried. Knowledge without precision becomes expensive. So what does precision actually look like? It is waiting when your mind wants movement. It is entering only when structure is clear, not when hope feels strong. It is sizing positions according to plan, not emotion. It is accepting risk before entering, not negotiating risk after price moves against you. It is doing ordinary things with unusual consistency. Simple actions, sharp execution, repeated daily. Do you see how different that is from how most people trade? Most are hunting excitement. Precision avoids excitement. Most are trying to predict. Precision waits to confirm. Most are emotionally involved in every tick. Precision stays detached, observing behavior rather than becoming trapped inside it. That calm difference changes everything, because precise traders preserve energy. They spend less time recovering from mistakes. They make fewer emotional decisions. Their confidence becomes steady because it comes from repeatable action, not random wins. Over time, consistency grows. Not because they force profit, but because they remove unnecessary error. That is how professionals think. Not, how much can I make today? But, how well can I execute today? A very different question. And better questions create better outcomes. Watch your own habits closely. Where are you loose? Where do you act too quickly? Where do you bend your standards because discipline feels inconvenient? Precision is usually not missing from your strategy. It is missing from the small moments where emotion quietly takes control. That is where performance is decided. Before profit, there must be precision, and precision begins with the next choice you make. Most traders want dramatic change, a new system, a powerful strategy, a sudden breakthrough that transforms everything overnight. But lasting improvement rarely arrives with noise. It comes quietly. A small adjustment in discipline, a slight improvement in patience. One repeated mistake removed from your routine, one emotional reaction brought under control. These changes do not look impressive at first. No one celebrates them. No excitement surrounds them. Yet over time, they create results loud enough to change a trader's entire path. Quiet corrections. Loud results. Have you noticed how trading mistakes are often obvious only after the damage is done? In the moment, they feel small. Entering a little early feels harmless. Ignoring one rule feels flexible. Holding a loser slightly longer feels reasonable. Taking a revenge trade feels justified because you want balance restored, Nothing seems dangerous at first, but markets punish repeated weakness. What feels small once becomes costly through repetition. That is where quiet correction matters. The sharp trader does not wait for disaster to force change. He studies friction early. He notices patterns others ignore. He sees where emotion quietly leaks into execution. He catches the subtle moments where discipline weakens. Not the big collapse, but the small crack forming before it widens. That awareness changes everything, because what you correct early never grows large enough to control you. Think about impatience. It rarely announces itself clearly. It whispers. It tells you to enter now because the move may leave without you. It makes waiting feel foolish. It creates urgency where there should be calm observation. And once impatience shapes one trade, it often shapes the next, then the next, until rushed execution becomes normal. One quiet correction, waiting for confirmation, can reverse that entire pattern. Now entries improve. Better entries reduce stress. Reduced stress improves judgment. Improved judgment strengthens confidence. Confidence makes patience easier. One small fix creates a chain reaction. That is how results become loud, not through force, through refinement. The same is true with risk. Many traders think their issue is market direction, when their real problem is position size. They trade so large that every movement feels personal. Fear increases. Decision quality falls. Winners are cut short. Losers are managed emotionally. Chaos grows, not because the setup was weak, but because size destroyed clarity. Reduce exposure slightly, and suddenly the mind becomes sharper. Patience returns. Logic returns. Execution improves. Again, a quiet correction. Again, a loud result. Do you see the pattern? Trading rewards those who respect small details. Not glamorous details. Not exciting details. Quiet ones. Consistent ones. The kind that happen in private, when no one is watching, when temptation appears, when discipline becomes inconvenient, when your old habits ask to return. That is where real traders are shaped. They make adjustments nobody notices. Then months later, everyone notices the outcome. Steady growth, calm confidence, cleaner execution, stronger discipline. What looked like sudden success was built on silent correction. Most people search outside themselves for answers. The wiser trader looks inward. He asks, what small behavior keeps repeating? What hidden habit keeps weakening my edge? What tiny improvement, practiced daily, would change my performance over time? Because greatness in trading is often built in places that look too ordinary to matter, and what seems quiet today can become powerful enough to reshape everything tomorrow. Most traders only measure the obvious cost. Money lost on a bad trade, a missed move, a poor entry, a stop-loss hit. But the most dangerous losses in trading are often hidden. They don't appear clearly on your statement. They build quietly beneath the surface, shaping your habits, weakening your judgment, and slowly pulling you away from consistency. Tiny mistakes carry hidden costs, and those costs are often far bigger than traders realize. Have you ever thought about what one careless trade actually costs? Not just the dollars lost, but what follows. A rushed entry creates frustration. Frustration clouds the next decision. The next decision becomes emotional. Emotional trading increases mistakes. Mistakes damage confidence. Damaged confidence creates hesitation on good setups. Then hesitation causes missed opportunity, and missed opportunity creates regret. One small mistake starts a chain reaction. The original loss was small, its effect was not. That is the hidden cost. Most traders never calculate emotional damage. They never measure lost discipline. They never account for the mental fatigue created by impulsive action. Yet these invisible costs shape performance more than one losing trade ever could. A trader who breaks his rules and gets rewarded learns something dangerous. Bad behavior can work. That lesson is expensive. Because now discipline weakens. He starts trusting impulse more than process. He becomes loose with entries, flexible with stops, casual with risk. He feels sharp because recent outcomes were positive, but beneath that confidence is structural weakness quietly growing. Then pressure comes, and weak structure breaks. Do you see why small mistakes matter so much? They are rarely isolated. They teach habits, and habits become identity. The trader who constantly bends rules becomes a trader who cannot hold discipline under pressure. The trader who often exits too early becomes someone who struggles to let edge fully play out. The trader who chases movement becomes trapped in reaction instead of observation, all from small repeated errors. Not dramatic mistakes, ordinary ones. That is what makes them dangerous. They look harmless. A little impatience, a little greed, a little fear, a little ego, tiny cracks. But cracks widen when pressure builds. The wise trader studies these small moments carefully. He understands that performance is not only built by what he does right, but by what he stops doing wrong. He watches for patterns in behavior, not just patterns on charts. He asks difficult questions after every mistake. Why did I rush there? Why did I ignore my plan? Why did I need action? Why did emotion feel stronger than discipline? Honest answers reveal hidden cost, and awareness creates correction. One trader learns to stop forcing trades. Another learns to reduce size. Another learns to walk away after emotional loss. Another learns to wait for confirmation instead of prediction. Small corrections remove hidden damage, and suddenly consistency starts appearing where chaos once lived. Because when invisible leaks stop, strength has room to build. Confidence becomes cleaner. Thinking becomes calmer. Execution becomes sharper. Results improve naturally, not because the market changed, but because the hidden cost of tiny mistakes was finally understood. Most people think success comes from adding something new. Often it comes from removing what quietly hurts you. Most traders think progress in trading must look big. A major winning streak, a dramatic jump in account size, a sudden breakthrough where everything finally clicks. But real progress rarely moves that way. It advances quietly, in inches. A little more patience than yesterday. Slightly better risk control. One fewer impulsive trade this week. One stronger decision under pressure. One emotional habit kept in check. These are small gains, easy to overlook, almost too ordinary to respect. Yet over time, they travel miles. That is how disciplined traders are built. Have you noticed how decline also happens in inches? Rarely through one giant mistake. More often through small compromises. You loosen your entry standards just a little. You hold risk slightly longer than planned. You increase position size because confidence feels high. You chase one setup because boredom whispers that waiting is wasting time. None of it feels dangerous in the moment. But repeated inches in the wrong direction become distance. And distance becomes damage. The opposite is true as well. Small discipline compounds. When you wait for clear structure, you avoid weak trades. Avoiding weak trades protects capital. Protected capital keeps confidence stable. Stable confidence improves execution. Better execution strengthens trust in your process. Trust creates patience. Patience improves selection. Selection improves outcomes. 1 inch, then another, then another. Eventually, what looked small becomes transformation. That is the quiet power most traders underestimate. They want miles immediately. But miles are earned through inches. Do you know what makes this difficult? Inches feel unrewarding at first. No excitement. No dramatic story. No instant proof. You improve slightly, and results may not change overnight. You become more patient, yet still take losses. You tighten risk, yet miss some big moves. You reduce overtrading, yet profits may grow slowly. This is where many traders fail. They abandon small discipline because large reward is not immediate, but markets reward consistency, not impatience. The trader who respects small discipline today builds strength that shows later. He develops emotional control quietly. He sharpens judgment through repetition. He becomes harder to shake, less reactive, more selective. Over time, his edge becomes clearer, not because he discovered something magical, but because he stopped violating what already worked. That is wisdom in trading. Master simple things deeply. Most traders keep searching for complexity because simple discipline feels too plain. But trading often improves when unnecessary action is removed, not added. Fewer trades, cleaner setups, smaller size when emotions rise, more review, more honesty, more waiting. Simple inches, powerful miles. Look at your own habits. Where can you improve by just 1 inch? Can you wait 5 more minutes before entering? Can you reduce size slightly to think more clearly? Can you stop after breaking one rule instead of letting one mistake become 3? Can you sit still when the market offers nothing clean? These are inches, but repeated daily, they change identity. You become calmer, sharper, more deliberate. Most traders search for a big edge, one strategy powerful enough to change everything. One setup so reliable it solves inconsistency. One insight that suddenly makes trading easier. That search keeps them distracted, because markets are rarely mastered through one big advantage. They are mastered through small edges, repeated with discipline. A better entry, a cleaner exit, a little more patience, a little less emotion, slightly sharper risk control. Small advantages, almost invisible on their own, become powerful when stacked over time. That is how lasting wealth is built. Have you ever wondered why skilled traders often look almost boring? They are not constantly chasing action. They do not force trades. They do not need excitement to feel productive. Their strength comes from quiet consistency, small smart choices made repeatedly, especially when emotion invites poor ones. That is edge, not brilliance, not prediction. Behavior. A trader who waits for confirmation has an edge over one who reacts too early. A trader who accepts small losses quickly has an edge over one who negotiates with risk. A trader who protects capital during unclear conditions has an edge over one who trades simply because the market is open. Each advantage looks small, but markets reward accumulation, and small edges compound. One better decision may save only a little money today. One avoided emotional trade may protect only a small amount of capital. One extra layer of patience may improve entry by only a few points. Minor gains, small savings, tiny improvements. But repeat them over months and years, and now the difference becomes massive, not because of one dramatic move, but because waste was reduced and quality was increased again and again. That is the quiet math of trading. Most people understand compounding in money. Few understand compounding in behavior. Good habits strengthen themselves. Patience creates better trades. Better trades create confidence. Stronger confidence makes patience easier. Clear thinking improves execution. Better execution reinforces discipline. One small edge feeds another. Soon, your process becomes stronger than your impulses. That is when consistency starts taking shape. But there is another side. Small weaknesses compound too. A little greed slowly becomes oversized risk. A little impatience becomes constant overtrading. A little ego becomes refusal to take losses. Small emotional habits quietly grow until they become structural problems. This is why serious traders watch details closely. They understand little things are never really little when repeated often enough. Do you study your edges this carefully? Not just strategy, but behavior. Do you know what decisions improve your performance slightly? What habits reduce unnecessary loss? What conditions make your judgment sharper? What emotional patterns quietly weaken execution? Answers to those questions build real edge, and real edge often looks ordinary. Waiting when others rush, doing less when others overdo, thinking clearly when others react emotionally, protecting capital when others chase opportunity. Simple behavior, powerful effect. Most traders obsess over outcomes. Did the trade win? Did the setup fail? How much was made? How much was lost? Their emotions rise and fall with results, and because of that, their judgment becomes unstable. A winning trade makes them feel smart. A losing trade makes them question everything. Confidence becomes fragile because it depends on what just happened. That is a dangerous way to trade, because outcomes are noisy. Process is clear, and when the process is broken, the outcome owns you. When the process is strong, the outcome loses power. Have you ever taken a perfect trade that still lost money? Of course. And have you ever taken a reckless trade that somehow made money? That happens too. This is where most traders become confused. They judge quality by result instead of decision. They reward bad behavior because it worked once. They punish good behavior because it failed once. Slowly, discipline weakens, and emotional thinking takes control. That is how consistency slips away. The wiser trader understands something simple but powerful. Your job is not to control results. Your job is to control process. Did you wait for your setup? Did you respect risk? Did you follow your plan? Did you stay disciplined under pressure? Those questions matter more than whether one trade won or lost. Because process shapes outcome over time, and time is where edge reveals itself. Think of trading like planting seeds. You can choose good soil, proper timing, and careful attention. But you cannot command immediate harvest. Weather changes, conditions shift. Some seeds fail. That does not make the method wrong. What matters is repeating sound action, again and again. That is how results are freed. When process becomes your focus, something changes inside you. Losses stop feeling personal because they are part of the business.